So the lending process, again, you want to make sure they're pre-qualified. And if it's a referral like I talked about, sometimes you can, the way I find out if they're approved or not without coming out and saying, are you pre-approved? Because that can be abrasive sometimes, and if you're trying to capture business, what it really sounds like is, can you even afford this house? And you don't want it to sound like that. So the best way I've learned to find out if they're pre-approved or not is ask, are you guys happy with your current lender? It's an assumptive question. I'm assuming they've already talked to a lender and they're already approved. If they are, they're going to say, yes, I love them, or I went online and did this, or they're going to say, we haven't talked to a lender. I'm going to find out what their approval situation is by asking that assumptive question. And it's not abrasive or rude. It's, are you guys happy with your current lender? Very simple process. So refer to a lender. There's a lot of technical questions, especially nowadays with rates and buy downs and blah, blah, blah. Everything's changing. It's a very volatile environment for lending right now. So refer to a lender for all those questions. I was talking to a builder earlier. I think the market will slowly kind of come back to normal once there's more stability in the rates. Because someone might decide to buy a house, get pre-approved, shop for 30 days, and then the rate might be a point higher than it was 30 days ago. It's just very volatile right now. So when some stability comes back to the lending markets, I think sales will start to climb and all that kind of stuff. So refer to a lender for a very volatile market that we're in right now, or anytime. It's important you work with a lender you trust. Try to avoid out-of-town lenders. They're not bad or crooked or anything like that. They're just far away. They care less. You think they really care if they don't close your $250,000 house on time in Oklahoma City? They don't care. If something happens at 5 o'clock on a Friday, it's going to wait till Monday. They just don't care. I always like working with mortgage brokers because they only get paid when the deal closes. Banks, most lenders, loan officers at a bank, they get salaries and then they get commissions, but they get paid. So if it doesn't close, they still get paid. Mortgage brokers, they don't get paid until the loan closes and sells. So a lot of mortgage brokers don't get paid for like 30 days after a deal closes because it has to actually sell. So they care more. They're working weekends, they're working nights. Their job is to get a deal done, not to answer questions and push paper. So local lenders, local mortgage brokers are typically going to be the most responsive and best customer service. Not always, but in my example, or in my experience. So a couple things. So again, refer to your lender for rates, lending questions. Can I do this? How much does it cost to do this? My uncle did this. What about, all that junk? Get with a good lender. Say, ask Shelby about that, or ask your lender about that. That's a good question. A couple things you want to cover with them are going to be like, how does the actual terms of an offer work? So they want to understand down payment versus closing cost. Brand new buyers, first time buyers, someone who hadn't bought in a long time might not understand. Down payment is money that a buyer must bring towards the loan amount, and a seller cannot help the buyer with that amount of money. So it's going to be like your 3.5% down, your 5% down, your 20% down. That's a down payment. Sellers cannot contribute towards that money. That has to be out of your pocket. It has to be out of verified funds too. So it has to be money that's been sitting in a bank account for 60 or 90 days. So down payment goes towards your loan amount. Closing costs, however, are fees associated with the transaction. It's the appraisal cost, your inspection cost, your insurance, gap checks, your prepaid taxes, prepaid insurance, underwriting fee, all the other fees associated with the transaction. Normally can be $4,500 to $8,000 depending on the size of the house. Those are closing costs, and they are just fees to the title company, to the lender, to the inspectors, that kind of stuff, insurance. Sellers can help with these costs. And so this is what we're seeing this come back a lot now. For 2 years or so, you went above list price and you didn't ask for anything. Now we're having stuff sit on the market longer, so you're seeing realtor remarks that say, seller will contribute to point buy downs, seller will contribute to closing costs. Sellers are more willing now to contribute to these costs that are associated with buying a house. So sellers can help with closing costs. You can either just credit it towards closing and it reduces what you need to bring, or you can credit towards point buy downs is a popular thing now with rates being so volatile. But again, important to kind of explain the difference. Down payment goes towards your loan amount. Sellers cannot help. Closing costs, there's fees associated. Sellers can help. We can ask for closing costs. We can't ask for down payment assistance. Okay, there is down payment assistance, but that comes from the lender, not from the seller. so we can ask for closing costs. Let me touch on that. Down payment assistance, there's programs states and federal governments, municipalities offer for like first responders, teachers, first-time home buyers, stuff like that. Sometimes if you're in one of those industries or jobs, there are down payment money available for you. If you do take down payment money, it raises your interest rate. So nothing's free in this world. So if you think you're getting something for free, there's something on the back end you're paying, and it's usually interest rate or closing costs go up too. So those are available, but again, refer to your lender. Sometimes I've had first-time home buyers not take advantage of a first-time home buyer down payment assistance because it didn't make sense. They had the money, rate would go up, doesn't make sense to pay it. If you're gonna live there for more than X number of years, it doesn't make sense to pay it. And the last thing is earnest money. Make sure they understand at the time of the contract, I'm going to need a check from you at the time of the contract. We don't have to wait till it closes. Typically, it needs to be 1% of the purchase price, approximately. If the purchase price, we negotiate down to like $253,125, it doesn't need to be that, 1% of that. It can be like $2,500. So, but it really needs to be approximately 1%.
Hey, on the lending, Curtis did a class here this summer, and he brought something up, like when you work with investors, I'm not trying to call the subject, but he said you really want to try and use a lender that's basically kind of like, more is really like suggesting a local bank, and so versus using like Shelby, for example. Why would they say that?
So I'm going to dive into banking a little bit more. So there's two types of loans. There's a conforming loan, or you might hear it called a secondary market loan, and then there's like in-house lending. So most mortgages are bundled and sold as investment products to Wall Street. You might have watched the movies and heard everything about what happened in 2000 to 2007. So most mortgages, a Bank of America that does your mortgage, they're going to sell it. Wells Fargo that does your mortgage, Shelby does your mortgage, they're going to sell it to the secondary market, which means they're going to combine it with 2,500 other mortgages and then sell it to someone. So that's a conforming mortgage. That means it has to fit inside of a box that the people on the secondary market are going to buy it from. You have to have X credit score, you have to have X in reserves, you have to have X, it's a conforming mortgage. It fits in a box. So that's what mortgage brokers, most banks, most homeowners getting it. The reason they do that is because you fit in a box, you're going to qualify for a better rate. It's your primary residence. You're a better risk for the bank. So they're going to give you lower interest rates. They're going to require a lower down payment. They're going to accept lower credit scores. So does that make sense? So it's just a more consistent borrower and product. And that gets sold to the secondary market. In-house loans are going to be like what banks do. So he recommended calling community banks, any bank that starts with the First State Bank of, or the First Community Bank, Trust and Loan, Savings and Loan, all those banks, those are community banks, and they hold in-house books, or they hold in-house loans, or warehouse loans, you might call them. But they write the loan and then they keep the debt. They don't sell it to anyone. So it's riskier. It's investors, it's people putting less money down, it's rental, it's secondary properties, stuff like that, where the bank will charge you slightly higher interest rate. A house, a $200,000 house in the Village, if you buy it for your home, you could get a 5% interest rate. If I buy it for a rental, same home, same everything, it's a rental for me though, I'll pay 6.5% interest, 1.5 higher. It's a riskier loan because it's not my house, right? So that's an in-house versus a conforming mortgage is going to be safer. They're going to sell it in-house. They're going to charge more and keep it. So investors work with community banks more, local banks, and they're more, they are the debt holder. So they can make their own call. Versus if I'm selling it to the secondary market tells me the box I need to put that loan in. Does that make sense? So I can be more flexible. If I'm a local bank working with an investor, I can be more flexible on my terms, the deal, the price, the appraisal, blah, blah, blah. Okay. Does that kind of make sense? Yeah. Try not to go too deep into that, but basically it's what happens to the debt after the loan is written. Does it sell to the secondary market? If it does, they want it to be in a conforming If it doesn't, they keep it.
Mortgage brokers are going to work with an investor, or are they going to try to?
Yeah, they are. So investors can still get secondary market mortgages, like conforming loans. They're just not as desirable. You can't get as many. There's the lower risk threshold. I think you can only get like 10 conforming mortgages on rental properties through like Fannie Mae, Freddie Mac, which is the main investors for secondary market loans. So I can go get 100 loans through a bank if they let me. If they probably won't because it's too much. But I can only get 10 through the secondary market.
It makes sense now.
Yeah. So that's it just allows. It's a higher risk threshold banks will take, so they'll charge you more money, but they'll give you riskier loans, in their eyes, riskier. Versus a mortgage broker or bank, it's going to be a secondary market.
Okay.
Does that kind of make sense? I hope I explained that kind of well. It's a very, very complicated, complex ecosystem, finance, all of finance, especially when we talk about mortgages. But that's where, as I've done my own personal investing and bought houses and met lenders and stuff, met banks, it's very much, if you're getting a home loan, it's like, it is what it is. You need this credit score, you need these reserves, you need this down payment, you need blah, blah, blah. Banks, if you can have more relationship banking, where if they like you and know you and trust you, they'll be lenient with you. They won't require this, they won't ask for that, that kind of stuff. So relationship banking exists more with those community banks and stuff.
That makes sense.
Versus, Wells Fargo, US Bank, there's 3 or 4, Chase used to do it, used to buy up every freaking mortgage in America. There's like 4 banks that bought all of them. And so they don't care about you at all. You're a number inside of a bigger number, inside of a bigger number that they buy. And so it's just, you have to match it and it sells out.